think for us, the strategy coming into this sell-off has been one that is quite neutral on beta. So the gist being, we don't really see the tariff uncertainty as necessarily recessionary. Our macro base case is still one of stagflation as defined by below trend growth and elevated inflation risks. However, we know that volatility is quite elevated, and so it makes sense to, rather than chase beta, to pick your spots either where you're more shielded from such noises in the interim, or where valuation and fundamental drivers are a little bit stronger, and combine that with ample protection in the portfolio. And by that, I don't necessarily mean just diversification, but protection, for example, by going long volatility. After all, even though VIX's increase is still relatively low versus the historical highs.
I'll ask one technical question and we'll move on, but where do you pick up that volatility? Where do you pick up that premium? Because I'm an ex-derivatives trader, so I'm fascinated to see how someone like Fidelity does that.
We build put options in the portfolio in European or US indices, and we'll move our strike price according to the market and structure so that we get ample protection, but we're also not overpaying for the premium.
Okay, and I'll ask one more technical question. Do you trade the gamma on that, or do you just leave it and hold it? It's protection that's there to erode over time.
We tend to move the strike actively with the market.
Okay, right. And so as your delta changes, you change your position. Got it.
Let me ask you about Germany. We'll broaden it back out to a little bit more of a thematic question. Germany is obviously in focus today because of the major sell-off we're seeing in the German auto space. You have been pretty cognizant of the risk of trade uncertainty weighing on German large caps. So what do you think of German small and mid caps? It seems like that's where your focus is as a way to potentially shield the portfolio from some of these exogenous variables.
Yes, so it's pretty incredible coming into the year where we see this big rotation from US large cap into international stock, especially German stocks as well. The reason why we hadn't been chasing the rally as much has been indeed what you were talking about. There's trade uncertainty, even though there's positive catalysts such as the German fiscal package, the defense spending, and still a very dovish ECB policy outlook. And that's why we've decided to instead focus on mid-cap DAX, where you get better ROE versus DAX, and it's lagged DAX for a couple of years in terms of performance. And the percentage exposure to exports is much smaller, and so it's more geared towards domestic exposure and more correlated with domestic industrial activity.
Given your global focus, what do you think of Chinese equities here and the place they might have in a portfolio in the current macro environment?
So China has been an interesting case for us. So we had some small allocation to China throughout back end of last year and this year, thinking that, look, we have a potential policy bottom. We've seen very strong willingness from policymakers to put a floor to growth, not necessarily flood the market with liquidity, but put a floor to growth. And the attitude towards private enterprises has changed as well. We've seen policymakers meeting the tech enterprise entrepreneurs, which is quite a pivot from seeing potentially tech as a bit of an issue to the part of the solution to the growth challenge. Now, with the AI story as well, we're seeing potentially earning catalysts. So frequently people talk about Chinese stock market rally. It could be quite sharp and fast, but this time we're starting to see earnings upgrade as well, especially in the tech space. That's why we've been adding on weakness to the Chinese exposure that we've had, because this time we think fundamentals might actually also be supportive.